In this video, I'm going to explain how the Australian tax system works and how you can easily calculate how much you're going to pay in tax each year on your tax return. Let's get straight into it. The Australian tax system operates on a progressive tax structure. This means that the tax rates increase as your income rises. The more money you earn, the more you are taxed. The Australian tax system consists of 5 tax brackets, each with its own tax rate. If we go to the ATO website, they provide a table of the Australian tax brackets for the 2023 to 2024 financial year. The first bracket is tax-free, so you can earn up to $18,200 and not have to pay any tax at all. Then moving on, we have what's called marginal tax rates. Once your income goes past the tax-free threshold, you will be taxed on the remaining income based on your marginal tax rates. Marginal tax rates refer to the tax rates applied to each portion of your income within these tax brackets. The second bracket charges you 19% tax for any amount you earn between $18,201 and $45,000. The third bracket charges you $5,092 plus 32.5% for any amount between $45,001 and $120,000. The fourth bracket charges you $29,467 plus 37% for any amount between $120,001 and $180,000. And finally, the fifth bracket charges you $51,667 plus 45% for any amount over $180,000. Now you may be wondering what these amounts are, and basically they are the maximum amount charged for the previous tax brackets. Let me show you an example with my own table to help you understand better. James is a project manager who earns $220,000 per year. Let's work out how much tax James would have to pay for the year using the tax brackets. We start off with the first bracket, which is the tax-free threshold. So the first $18,200 will pay 0% tax. For the second bracket, if you earn between $18,200 and $45,000, which is $26,800, you will be taxed 19% for that portion. So 19% of $26,800 is $5,092. This is the maximum amount of tax you can be charged on this bracket. For the third bracket, if you earn between $45,000 and $120,000, which is $75,000 in total, you'll be taxed 32.5% for that portion. So 32.5% of $75,000 is $24,375, which is the maximum amount of tax you can be charged in this bracket. For the fourth bracket, if you earn between $120,000 and $180,000, which is $60,000, you'll be taxed at 37% for that portion. So 37% of $60,000 is $22,200, which is the maximum amount of tax you can be charged in this bracket. And for the fifth bracket, you'll be charged 45% for any amount over $180,000. So since James earns $120,000, he will have $40,000 in this bracket taxed at 45%. 45% of $40,000 is $18,000. So if you total up all the tax from each bracket, it comes to $69,667, which is the total tax payable for James. But the tax does not end there. Every Australian is charged an additional 2% Medicare levy. This levy is to help fund Australia's public healthcare system. So those bulk bill doctor visits that you go to are not entirely free. You and many other Australian residents are helping to fund it by paying the Medicare levy through tax. So James has to pay an extra 2% Medicare levy on his $220,000, which comes to $4,400. In addition, if you earn over $93,001 as a single or $186,001 as a family, you'll be charged an additional 1% Medicare levy surcharge if you do not have an appropriate level of private patient hospital cover. So the Australian government encourages high-income earners to sign up for private health insurance to put less burdens on the hospitals funded by the public health system. And usually it's much cheaper to sign up for a qualifying private health insurance package than paying the surcharge, so it's probably a good idea to do it if you're a high-income earner. And if you're interested, I'll leave a link down below to an article that explains the Medicare levy surcharge in greater detail and how to avoid paying it. So for this example, let's assume that James already has the correct level of private health insurance. Therefore, he'll be exempt from paying the Medicare levy surcharge. So if we add up his income tax payable and his Medicare levy payable, we get $74,067. This is his total tax payable. Now there is a common misconception that a lot of people have about these tax brackets. I also used to think this when I was younger, and that is once your salary hits a certain bracket, all your salary is suddenly taxed at that higher rate. So for example, if I was earning $45,000 and I received a pay rise of $1,000, I used to think that the $1,000 will push me into the third tax bracket, and I would have to pay 32.5% on my entire salary. I mean, tax wasn't taught to me or many people in school, so I didn't know any better. So it's only when I studied finance at university that I found out this was not true. Your income is charged progressively per bracket, so if you ever get a pay rise, you'll only pay a higher tax rate on the portion that went over the bracket. So in this case, only the extra $1,000 will be taxed at the higher 32.5% rate and not your entire salary. I hope all this is making sense to you so far. And just to help you understand better, I'll go through a few more examples and show you how to easily calculate your tax. A useful online tool I like to use is this income tax calculator on the Money Smart website, which is a calculator provided by the government that does all the work for you. And I will link it down below, so feel free to check it out. So using this calculator, in the first example, Sally earns exactly $45,000 per year and she wants to calculate how much tax she must pay for the year. So using the calculator, let's enter $45,000 here. Now from the tax table, we know Sally falls into the second tax bracket. So the first $18,200 is tax-free. If we minus $45,000 by $18,200, we get $26,800. This is the amount that will be taxed at 19% as per the second tax bracket. So $26,800 times 19% equals $5,092. This is Sally's income tax payable. Then we need to include the 2% Medicare levy on $45,000, which is $900. This is Sally's Medicare levy payable. So if we add them together, that is $5,992. This is the total tax Sally will have to pay for the year. Easy peasy, right? Let's move on to the second example. Ben earns $70,000 per year and he wants to calculate how much tax he must pay for the year. So Ben falls into the third tax bracket. So he'll be charged $5,092 upfront, which is the portion of income between $18,201 and $45,000 as per the previous example with Sally. Then he'll be charged 32.5% for any amount over $45,000. So $70,000 minus $45,000 is $25,000. $25,000 times 32.5% is $8,125. This is Ben's income tax payable. Then we include the 2% Medicare levy on $70,000, which is $1,400. This is Ben's Medicare levy payable. And if we add this all up, the total is $14,617. This is the total tax Ben will have to pay for the year. Let's move on to the third example. Mia earns $110,000 and received a $20,000 pay rise at the start of the financial year. She wants to calculate her take-home pay before and after the pay rise. So this is a perfect example to prove the misconception that getting a pay rise may push you into a higher tax bracket, which will lower your take-home pay. So let's look at scenario 1 before she received the pay rise. $110,000 per year puts her on the third tax bracket. So as per the table, she must pay $5,092 plus 32.5% for any amount over $45,000. So $110,000 minus $45,000 is $65,000. $65,000 times 32.5% is $21,125. So if we add $5,092 and $21,125, we get $26,217, which is Mia's income tax payable. Then we include the 2% Medicare levy on $110,000, which is $2,200. And in this example, Mia does have an appropriate level of private patient hospital cover, so she does not need to pay an extra 1% on Medicare levy surcharge. If we add all this up, the total is $28,417, which is the income tax payable plus Medicare levy. So if we subtract that from her total salary, Mia's take-home pay after income tax and Medicare levy is $81,583. Now let's look at scenario 2 after Mia received the pay rise. The extra $20,000 increases Mia's total salary to $130,000, which pushes her to the fourth tax bracket. So if we follow the table, she has to pay $29,467, which is just the total income tax for $120,000. That leaves $10,000 remaining, which will be taxed at 37% as per the fourth tax bracket. So $10,000 times 37% is $3,700. If we add $29,467 with $3,700, we get $33,167, which is Mia's income tax payable. Then we include the 2% Medicare levy on $130,000, which is $2,600. And again, since Mia has the correct private health cover, she does not need to pay the extra 1% Medicare levy surcharge. If we add everything up, the total is $35,767, which is the income tax payable plus the Medicare levy. If we subtract that from her total salary, Mia's take-home pay after income tax and Medicare levy is $94,233. So if we compare the two scenarios, you'll see that after tax, Mia will take home an extra $12,650 if she receives the $20,000 pay rise. It's that simple. Feel free to play around with this calculator for your own salary and see what you come up with. It is important to note that the tax rates may change each year, so if you're watching this video in the future, make sure you look up the current tax rates for the current financial year. By the way, if you're enjoying this video, the secret word today is tree, so comment it down below so I know you made it this far. Also, consider subscribing to the channel as I'll be making many more videos like this in the future and you don't want to miss them. And if you're interested to learn how you can legally reduce your tax in Australia, check out this video on screen where I go over 8 legal ways you can reduce your tax bill. Thank you for watching, I appreciate you, and I'll see you in the next video.